Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Micron technology.
If you find our talks useful, please consider subscribe, like, and comment underneath because it really helps us out.
Yeah, and before we jump into things today, just a really quick heads up about StockOracle. We've got a special 14-day trial link right down below in the description.
Right. And, for those who are new, StockOracle is this AI-aided stock research platform we use to help sort through all the noise. But we have to be super clear here. It is definitely not financial advice.
Exactly. It's not a trading signal service. It's not real-time market data, nothing like that.
Yeah. Oh, and that link in the description, that is an affiliate link. So the channel might earn a commission if you use it, but, at no extra cost to you.
And one last thing on that, please remember that AI insights and valuation estimates, they can be incomplete or just completely wrong. So always verify the important facts yourself.
Absolutely. Do your own homework. But, okay, let's get into the wealth building context for today. Because, the situation with Micron technology right now is honestly kind of mind-bending.
Oh, it really is. It's a complete contradiction.
Yeah. Okay, imagine you own the only gas station on this massive, isolated stretch of desert highway.
Right. Okay, yeah, I'm picturing it.
Every single car coming down that route desperately needs your fuel. The line stretches for miles. And people are actually so terrified of running out of gas that they are paying you 3 years in advance just to hold their spot in line.
Wow. So you're just flush with cash?
Exactly. You're flush with cash. Your margins are astronomical. Demand is virtually guaranteed.
Yeah.
But, and here's the crazy part, somehow the bank is still valuing your business like you're about to go bankrupt tomorrow.
Right, which makes absolutely zero sense on paper. You have this guaranteed future revenue and massive current cash flow, yet the market is, pricing in an imminent catastrophe. The underlying assumption has to be that, either the highway is going to shut down entirely or someone else is about to build a much bigger gas station right next door.
And that metaphor pretty much perfectly captures the extreme contradiction we're seeing in the semiconductor space today, especially with Micron. The market is just severely conflicted.
Completely. Because we are looking at a company that just reported one of the most dramatic revenue accelerations in its history.
Yeah, they grew an astonishing 167% year over year.
Right. But despite that explosive growth, the stock recently suffered this brutal 30% drop from its 52-week peak.
Okay, so we really need to unpack this. Because to understand the market's confusion, we first have to look at how this company is trying to completely rewrite its business model, on the back of the AI boom.
Exactly. And to appreciate that shift, you really have to understand what the memory chip business used to be.
Right. For decades, producing GM dynamic random access memory, which is basically the short-term working memory for computers, it was a lot like being a farmer.
Yes, the farmer analogy is totally spot on for the historical DRAM market.
Right. You invest billions of dollars planting the seeds, which in this case means building these massive state-of-the-art fabrication plants.
Which takes years, by the way.
Yeah, years. And then you run those machines 24/7, and you just have to pray that when the chips finally come off the line, the market price hasn't completely crashed.
You were entirely at the mercy of quarterly spot prices.
Right.
If there was a glut of chips on the global market, you had to sell your harvest for pennies just to clear out the inventory.
It was this notoriously brutal boom and bust cycle. In a good macro environment, everyone made money hand over fist. But the moment there was an oversupply, margins would evaporate almost overnight.
Because memory was basically treated as a fungible commodity. A chip from Micron was largely the same as a chip from Samsung.
Right. But what we are seeing in these recent financials is a fundamental break from that history. Let's look at the fundamentals here. The numbers they're posting simply do not belong to a traditional commodity hardware business.
No, they really don't. Let's look at the actual numbers for their fiscal third quarter of 2026, because honestly, I had to read them twice to make sure they weren't typos.
Yeah, same here. They reported $41.46 billion in revenue.
Which crushed their own internal guidance by nearly $8 billion.
It's insane. And they didn't just sell a lot of volume, they made an absolute fortune doing it. They posted a 55.91% net margin.
Which is just wild.
Right. Just to ground that for a second for everyone in hardware manufacturing, a 55% net margin is practically a myth. You usually only ever see that in SaaS-like software as a service where it costs literally nothing to duplicate code.
Exactly. Hardware requires physical materials, massive energy consumption, and incredibly complex logistics. So hitting 55% means their pricing power is currently absolute.
Yeah. But it's their forward guidance that really exposes this structural shift. Because for the fiscal fourth quarter of 2026, management guided for roughly $50 billion in revenue.
With an eye-watering 86% gross margin.
86%. I mean, how are they actually achieving that?
Wow.
And this goes back to my farmer analogy. They aren't farmers hoping for a good price at harvest anymore.
No, not at all.
The new model is way more like a landlord getting 3 years of rent paid upfront in cash for an apartment building that hasn't even been built yet.
Right. And the mechanism they are using to accomplish this is what Micron calls strategic customer agreements.
Yeah, so they have locked in 16 of these multi-year contracts spanning 3 to 5 years. And these aren't just like polite handshakes or memorandums of understanding.
No, they are legally binding agreements backed by roughly $22 billion in customer prepayments.
$22 billion in actual cash sitting in their accounts before the chips even ship.
That is the exact pivot from a commodity to a contract model. This $22 billion safety net effectively de-risks their near-term revenue profile. And more importantly, it provides them with the upfront liquidity they need to build the next generation of factories. And they can do it without taking on massive high-interest debt or, diluting their existing shareholders by issuing a bunch of new stock.
Which brings us to the catalysts. Let's pause and talk about the engine driving all this desperation. Why are companies willing to hand over billions in advance?
It all comes down to HBM, which stands for high bandwidth memory.
Yeah. And to understand why HBM is so critical, we have to look at how AI actually works at the hardware level. We hear all the time about NVIDIA's AI accelerators, the GPUs that act as the brains doing the complex math.
Right.
But a super fast brain is completely useless if it doesn't have data to process.
The industry actually calls this the memory wall. The processors have become so fast that they spend a huge amount of time just sitting idle, waiting for data to arrive from the memory chips.
It's like having a Ferrari, but you're stuck on a dirt road. So HBM is essentially building a 100-lane superhighway directly on top of the processor.
They physically stack these memory chips vertically, like a microscopic skyscraper.
Yeah, and punch thousands of tiny holes through them so the data can travel almost instantly. And because generative AI requires processing trillions of parameters simultaneously, the projections for this specific type of memory are just wild.
Yeah, the research expects the HBM market to grow from roughly $35 billion today to $246 billion by 2030.
$246 billion. That sevenfold increase completely explains the prepayments. The hyperscalers, the Amazons, Googles, and Microsofts, building out these massive AI data centers, they literally cannot afford to be starved of memory.
Because if they lack HBM, their billion-dollar GPU clusters just sit idle. They're paying whatever it takes to guarantee their place in line. The data indicates Micron has essentially sold its entire HBM production capacity all the way through 2027.
So you have a hardware company sitting on $22 billion in customer cash, generating software-like margins, and their premium product is sold out for the next couple of years. The historical move here is to build a bunch of factories.
And that is exactly the path they are taking, but on a scale that honestly makes my head spin.
Yeah, we are looking at a $250 billion capital expenditure plan in U.S. outlays planned through 2035. They're expanding these massive facilities in New York, Idaho, and Virginia.
Plus, an additional $24 billion investment in Singapore specifically for a dedicated HBM packaging line.
$250 billion in domestic infrastructure is just staggering. But I have to play devil's advocate here, because if you know the history of semiconductors, you know the classic trap.
The overbuilding trap.
Exactly. Chip makers always overbuild during a boom. They see endless demand, they announce these massive fabrication plants, and just as those plants come online a few years later, demand pools off. They flood the market with their own chips and they crash their own prices. Aren't they just setting themselves up for an even bigger, more catastrophic bust in 2028?
Well, that is the exact question institutional investors are wrestling with, and it's largely what's driving the skepticism in the stock. But the data suggests this cycle might be fundamentally different, mainly because of extreme supply rigidity.
What do you mean by that?
Well, building a modern fabrication plant isn't like building a warehouse. You don't just, pour concrete and install conveyor belts. You are building clean rooms that have to be thousands of times cleaner than a surgical operating room.
Right.
You are installing extreme ultraviolet lithography machines that cost hundreds of millions of dollars each and take months just to calibrate.
So even if they wanted to flood the market tomorrow, the physics and logistics of the supply chain literally won't let them.
Precisely. The new Idaho facility, for example, will not deliver meaningful volumes until the second half of 2027. The same timeline applies to a new fab they recently acquired in Taiwan. The physical constraints put a hard cap on supply.
Wow.
Furthermore, Micron's management is demonstrating a pretty rare cultural shift. They have publicly committed to, quote, flexible capacity management.
Meaning if demand drops, they will actually slow down the machines instead of running them at a loss just to maintain market share. They're acting a lot more like OPEC managing oil output.
Exactly. And they are backing that up with serious technological momentum. They already have their next-generation HBM4 in series production, which is tailored for NVIDIA's upcoming Vera Rubin platform.
Plus, they just unveiled the world's first PCIe Gen 6 SSD for AI data centers. To translate that jargon, PCIe Gen 6 is basically the newest, fastest data highway connecting long-term storage to the rest of the server. They're pushing the bleeding edge of the entire storage infrastructure, not just memory.
But management is clearly aware of the risk of being entirely dependent on a handful of massive data center clients. That concentration risk is severe.
Yeah, if a few hyperscalers sneeze, Micron catches a cold.
Exactly. That's why the diversification strategy they rolled out in July 2026 is critical to their long-term survival. They signed long-term supply agreements with major Tier 1 automotive suppliers, companies like Qualcomm and Hyundai Mobis.
Because AI isn't just going to live in server farms, right? It's moving to the edge. It's moving into smart vehicles that need to process terabytes of sensor data in real time and into robotics.
Securing those automotive deals acts as a vital hedge. If Amazon suddenly decides to slow their data center build-out, having long-term contracts with the global automotive supply chain provides an incredible revenue cushion.
Okay, so we have unprecedented growth, locked-in multi-year contracts, 86% margins, and aggressive diversification into automotive, which brings us back to our crashing stock price and the technicals. Despite all of this structural goodness, the stock fell 30% from its peak.
Right. Clearly, someone with deep pockets is betting heavily against them. We need to look at the risks and the overall bear case here.
Yeah, because the bear case is deeply rooted in competitive reality. As dominant as Micron's recent numbers look in isolation, they're actually the underdog in the global memory market.
They only hold about a 22% market share in DRAM. They trail significantly behind Samsung, who holds 38%, and SK Hynix at 29%.
They're essentially the scrappy third-place player trying to fight giants. If Micron stumbles for even a quarter on rolling out this new HBM4, those giants will eat their lunch, right?
Without a doubt. And those giants aren't sitting still. Both Samsung and SK Hynix are heavily capitalized and aggressively signing multi-billion-dollar deals of their own. In a pure-scale war, Micron is at a disadvantage.
Then there is the geopolitical element, specifically the Apple factor. Apple is reportedly seeking U.S. regulatory approval to use Chinese-made memory chips.
Right. If that goes through, it would allow Apple to diversify its supply chain away from companies like Micron. It's a cost play by Apple looking for cheaper components, but it directly threatens Micron's position with one of the most important hardware buyers on the planet.
Now, it is a speculative risk right now. No regulatory decision has been finalized, but it represents a structural threat. However, the biggest risk, the one that truly tests the entire bull thesis and justifies that 30% drop, is the renegotiation risk.
The so-called ironclad contracts.
Yes. The entire narrative of Micron as a predictable de-risk utility rests on those 16 strategic customer agreements. But what happens if the broader macroeconomy hits a severe recession? Will those tech giants simply smile and keep paying premium 2026 prices for memory in a depressed 2028 market?
Or will they leverage their massive market power to force renegotiation?
Exactly. If you're Microsoft or Google and the economy tanks, you have an army of corporate lawyers. You might just decide it's cheaper to breach the contract. You tell Micron, sue us, we're not paying these rates.
That is the exact fear keeping investors up at night. Now, it's important to note these are structured as take-or-pay contracts. This means legally, if the customer refuses to take delivery of the chips, they still have to pay a substantial financial penalty.
So it limits how much leverage the hyperscalers actually have.
It does. But the market hates legal uncertainty. And it's highly notable that famous short seller Michael Burry recently added to his short position against Micron.
Let's explore the mechanics of that short for a second. If their premium product is entirely sold out, and they have $22 billion in cash already sitting in their bank account, shorting this stock feels incredibly aggressive.
Yeah.
If they have to pay a penalty anyway, then Burry's short position implies he thinks the tech giants will just eat the penalty. It assumes a massive macro failure, right?
It implies a belief that the AI bubble itself is going to pop.
Yeah.
That the enthusiasm for generative AI won't translate into profitable consumer businesses, meaning the cloud providers will eventually stop buying GPUs and the demand for memory will crater.
And that macro pessimism is exactly what's bleeding into the stock's current valuation. Which brings us to the sentiment and how Wall Street is pricing this tug-of-war. The technical volatility is staggering. The stock hits $12,255 in June, falls over 30% in a few weeks, and then just recently exploded over 18% in a single day, closing around 874.
That level of price action is highly unusual for a mega-cap tech company. But look at the catalyst that drove that sudden 18% bounce. It wasn't even Micron's own press release.
Oh, right. Samsung came out and warned the market that their own memory shortages are likely to extend well into 2028. And Apple CEO Tim Cook publicly confirmed on an earnings call that memory costs are continuing to rise for them.
So their biggest competitor is publicly admitting we are out of supply, and one of the biggest buyers in the world is complaining that prices are going up. That completely validates Micron's claim that they hold the pricing power.
It proves the structural tightness in the supply chain is very real. But despite that validation, the valuation anomaly here is still massive. Currently, Micron's trailing PE ratio sits at an incredibly low 18.99.
A PE of basically 19 for a company with 167% revenue growth.
Right. Just to translate that, that implies a PEG ratio well below 1. You usually only see that in value stocks or industries that are slowly dying, not in semiconductor companies anchoring the AI revolution.
No, tech companies growing at a fraction of that rate often command PE multiples of 40, 50, or even 100. Wall Street is pricing Micron as if this current surge is just a temporary cyclical peak that is about to evaporate tomorrow.
But the analysts who actually cover the stock day-to-day seem to completely disagree with the broader market's fear. The consensus sentiment is overwhelmingly positive. Out of the analysts tracking the stock, there are 29 buy recommendations, 1 hold, and 0 sells.
And the average price target is sitting at $1,569, and firms like Susquehanna went as high as $1,750, arguing that a structural supercycle is firmly in play.
Which brings us to the final verdict. Based on the analysis, Micron has a bullish score of 8.5 out of 10. And I always like to pause here and remind everyone that this is just a raw analytical metric from the data models. We are not telling you to buy, sell, or hold this stock.
Right. Definitely not financial advice.
We just want to present the upside and downside. So what does this all mean when we put the pieces together? We have a low PE, massive contracted growth, and extreme price swings. It seems like the current market volatility driving the stock down was driven more by a broad sector rotation like institutional investors taking profits out of the entire AI hardware trade rather than any fundamental flaw in Micron's specific execution.
That is the most logical interpretation of the data. The fundamentals remain pristine, but they were caught in a macroeconomic downdraft, and this sets up an incredible inflection point for the market.
The upcoming fiscal Q4 earnings report in late September 2026 is going to be the ultimate stress test.
Well,
If they actually deliver on that $50 billion revenue target and maintain that 86% gross margin, it becomes mathematically very difficult for the market to keep pricing them as a fragile commodity.
it could force Wall Street to completely re-rate the entire memory sector, treating them more like high-margin, contracted SaaS businesses. It is a pivot from being a price taker at the mercy of the spot market to a price maker, dictating terms years in advance.
It is truly hard to overstate the sheer scale of the transformation we've discussed today. We are watching a company trying to break out of a decades-old cyclical curse by securing $22 billion in upfront cash, navigating massive geopolitical supply chain threats, and completely selling out their foundational product for years into the future.
And this raises one final, really important question for everyone's long-term view as we wrap up.
Oh, yeah.
We've talked about how great these multi-year contracts are for Micron's financial stability. But if the AI boom makes foundational hardware components like Advanced Memory Act more like long-term, prepaid utility contracts, Does that completely rewrite how we value tech infrastructure moving forward?
That's a huge question.
Right. Think about the broader ecosystem. If all the advanced memory in the world is contracted out years in advance by 4 or 5 megacorporations with deep pockets, what happens to the innovative startups trying to build new AI tools in 2028? If there is literally no spot market left to buy the chips they need, does innovation bottleneck entirely at the hardware level?
That is a chilling thought. Because if the hardware is locked up by the giants, the future is locked up by the giants. It's like realizing you have all the gas you need to drive as fast as you want, but you aren't the one controlling the navigation anymore. The coordinates were locked in by the highest bidder years ago. Well, if you found our talks useful today, please remember to subscribe, like, and comment underneath. It really helps the channel grow.
And be sure to check out that special 14-day trial link for StockOracle down in the description below.
Just one last reminder. StockOracle is an AI-aided stock research platform. It is not financial advice, it is not a trading signal service, and it doesn't give real-time market data.
Right. And since that is an affiliate link, we may earn a commission at no extra cost to you. But please keep in mind that AI insights and valuation estimates can be incomplete or wrong.
Always verify the facts and do your own research before making any moves in the market. Thanks for joining us today, and we'll see you next time.